Investment term of the day: mid-cap. Mid-cap is the term given to companies with a market capitalization between $2 and $10 billion. As the name implies, a mid-cap company falls in the middle of the pack between large-cap and small-cap companies. There are two main ways a company can raise capital when needed: through debt or equity. Debt must be paid back, but can generally be borrowed at a lower rate than equity due to tax advantages. Equity may cost more, but it does not need to be paid back in times of crisis. As a result, companies strive to strike a balance between debt and equity. This balance is referred to as a firm's capital structure. Capital structure, especially equity capital structure, can tell investors a lot about the growth prospects for a company. One way to gain insight about a company's capital structure and market debt is by calculating its market capitalization. Companies with low market capitalization or small caps have $2 billion or less in market capitalization. Large capitalization firms have over $10 billion in market capitalization, and mid-cap firms fall in between, ranging from $2 billion to $10 billion in market capitalization. Additional categories such as mega-cap, that's over $200 billion, micro-cap, $50 million to $500 million, and nano-cap, less than $50 million, have been added recently for the sake of clarity. The appealing feature of mid-caps to investors is that they are expected to grow and increase profits, market share, and productivity, which puts them in the middle of their growth curve. Since they are still considered to be a growth stage, they are deemed to be less risky than small caps, but more risky than large caps. Successful mid-cap companies run the risk of seeing their market capitalization rise, mainly due to an increase in their share prices, to the point where they fall out of the mid-cap category. While market capitalization, or market cap, depends on market price, a company with a stock priced above $10 is not necessarily a mid-cap stock. To calculate market capitalization, analysts multiply the current market price by the current number of shares outstanding. For example, if company A has 10 billion shares outstanding at a price of $1, it has a market capitalization of $10 billion. Company B has 1 billion shares outstanding at a price of $5, so company B has a market capitalization of $5 billion. Even though company A has a lower stock price, it has a higher market capitalization than company B. Company B may have the higher stock price, but it has 1/10 of the shares outstanding. Most financial advisors suggest that the key to minimizing risk is a well-diversified portfolio. Investors should have a mix of small, mid, and large-cap stocks. However, some investors see mid-cap stocks as a way to diversify risks as well. Small-cap stocks offer the most growth potential, but that growth comes with the most risk. Large-cap stocks offer the most stability, but they offer lower growth prospects. Mid-cap stocks represent a hybrid of the two, providing a balance of growth and stability. What makes mid-caps so attractive? No one can tell when the market will favor a specific kind of company, whether it's a large, mid, or small cap. So it's important to diversify your portfolio, as we mentioned above. But the percentage of mid-caps that you want to invest depends on your specific goals and risk tolerance. Whatever those may be, here are some reasons why investors may want to consider mid-caps as an investment. Investors can either buy a mid-cap company's stocks directly or buy a mid-cap mutual fund, an investment vehicle that focuses on mid-cap companies. And that was your investment term of the day.